A question I'm getting asked more and more, and I wanted to address in today's video is, hey, Azul, is this a good time to invest? As I record this, it's the end of May 2025, and it's been a volatile year to say the least. We had on April 2nd, Trump announced his tariffs. The market went through, a somewhat serious correction, and it has since pretty much bounced back to being flat for the year. And so people are wondering, is it safe to go back in? Excuse me. And I want to address a couple things. First, going into the year, a lot of us were saying the stock market is certainly not inexpensive at this point. Is it overvalued? I don't know, but is it expensive? That's hard for me to say, but one thing I do know is what I said earlier about, is it safe to get back in? Is it safe to start investing again? Um, yeah, it's a difficult question to answer because I don't think we should be bouncing in and out of the market, but what I think we should be doing instead is have a long-term asset allocation. So, if maybe during the last couple years you got a little over allocated to stocks, this might be a good time to take some chips off the table if it's not your long-term asset allocation. And conversely, if if you don't have enough exposure to stocks, this might be a time to visit with your financial advisor and say, does it make sense for me to increase my market allocation? Now, in hindsight, obviously, you wish you had done that when the market was down 10, 15, 20% earlier in the year. But the important thing here is to have a long-term asset allocation and not try to time the market, because when you time the market, you're probably going to end up losing. And I want to see you succeed. It's really, really hard to time the market. But candidly, if you have a long-term stock allocation, the odds are dramatically in your favor. And that's how I see people succeeding, is by having that long-term asset allocation. It's so important, that asset allocation, because it's going to determine 80, 90% of your investment success is going to be determined by what percent of your portfolios in stocks, what percents in bonds. One thing to think about is, for a lot of people, it might give you more mental solace, additional calm when things are scary. If instead of looking at what percent of your portfolios in safe, secure, short duration bonds, if instead of percentage, you think about how many years worth of living expenses do I have in bonds, so that you don't have to worry about being what I call a forced seller in a down market. Most of us, the way we become forced sellers in down markets is either the mental pain of the market being down, and as we retire, that pain of loss can increase, and it can increase substantially. And it can go from being worrying to being what I call angst, where you can't sleep at night when you've got that pit in your stomach, and you just can't get over it. And I want to see you avoid that. I want to see you have as many things in your favor as possible. And so getting that asset allocation is key. It's also, multiple studies have shown that your asset allocation has more to do with your success. It's like 80 or 90% of an investor's long-term success, as opposed to picking, quote unquote, the right stock. So the nice thing is you can work with a financial advisor on a project basis. I know many of you are not going to work with a financial advisor full time, just because we tend to charge 1% per year for the money that we're investing. But some financial advisors will help you come up with a long-term asset allocation. And that can be a great, great investment. If you're not going to work with a financial advisor at all, I urge you to use software designed to help you think through things like this. The software I like is called Bolden, used to be called New Retirement. You can find a link for it in the description. So whether you work with a financial advisor or use software like Bolden, I am an affiliate for Bolden. It's very affordable software. It's about $120 a year. And as an affiliate, if you order through my link in the description, I'll get a small piece of what you pay um, for that. So that's one thing to be thinking about. The next thing is just the whole idea of timing the market. I want to encourage you. Excuse the background music, the background noise here. We've got ice cream cones that we're picking up now. So, um, but with the asset allocation, it's also important to think about again your bonds are there for stability, and you wanna be careful because bonds can be every bit as risky as stocks. So there's different types of bonds, and when interest rates were lower, I saw people stretching for yield, and it's one of the reasons that 2022 was such a tough year for people to navigate because it was one of the few years in the last 50 or 60 years when both bonds and stocks were down at the same time. Now, in 2022, the Federal Reserve was raising interest rates, uh, and the tech industry was going through a correction as well. So stocks were down, and then also bonds were down because interest rates had risen so dramatically, and nobody wanted those bonds that were at low interest rates. You got to remember during COVID, when you and I were able to get our mortgages at 2.5%, 3%, the reason we were able to get such low interest rates on our mortgages was because not only was the 10-year, but also the 30-year treasury was at historic lows. And people were locking in their money for 10, 20, 30 years at very, very low interest rates. And so when when interest rates started to go up, those bonds went down and in some cases went down dramatically. In theory, a 30-year bond, if there's a 1% increase in interest rates, a 30-year bond's going to drop by 20, 22%. It's called duration risk. And the reason for that is you think about it, if you could get a 30-year bond at your normal interest rate that was a percent higher than what the market had, if you think about that, if somebody could get a percent higher more, then why would they want to have your bond that's paying a percent less? And so, in essence, they're getting 1% a year less for 30 years. And if you take the time value of money, it ends up being 22, 23 years, somewhere in there. So these things get complicated, but the essence is high quality bonds. Think about it in years and think about your asset allocation. So is now the right time to get back into the stock market? You know, none of us have a crystal ball, but what we can do is we can say that historically having a long-term asset allocation and sticking with it over an investment cycle, which unfortunately in my world, an investment cycle, 7 to 10 years, I think the odds are highly in your favor. But the key is to have that right asset allocation. If you enjoyed this video, the YouTube algorithm says this is the next video of mine specifically for you that you should watch next. Thanks for watching this one. Bye-bye.